help you become more educated so that you can make wise decisions when investing in this space. So really excited about our topic today because we're going to invite you into how we vet operators. And whether you're an established real estate investment team or an individual looking to start investing into apartments, I would suggest and recommend that you go through a similar process here. So as we've gone through deals and operators over the last few years, we've really nailed it down to three main categories, three areas that we look at, and this is the order that we vet them. Now, listen, if you have questions, feel free to throw them in a chat box. I've got a couple members of my team on the call, so they'll be overseeing that, or just speak up. So we've got a fairly small group today. So if you have questions, ask them. That's the whole purpose of having these webinars here. So appreciate you all coming on this morning. All right. Okay. So what we're going to be talking about is vetting the OMD. And what I mean by that, I got to turn my camera up, huh? What I mean by that is the operator, the market, and the deal. And so this is number one. You got to vet the operator. Number two, the market that the property is in. And then number three, the deal itself. And this is why. You can get a super great looking deal with a bad operations team, and they can drive that deal into the ground. You can get an okay deal with a great operations team, and they can execute on their business plan. So the mistake that a lot of new investors make when they go into this space is that they start at vetting the deal. Here's the thing. No operator is going to present a deal to you where the numbers look bad. Right? But this is what we do. We go in and we look at the deal and like, hey, those numbers check out. This looks good. Let's move forward with it. Before they vet the operator and then the market. So this is the process that we go through: the operator, the market, the deal. What I'm going to do is share with you 5 questions that we ask every time we look into these deals. Now, there's 100 other questions you need to ask. Excuse me, but these 5 questions are going to be a good place to start. And we actually have a handout that we'll share with all of you. In fact, Hillary, do you mind throwing that handout in the chat box? This might be helpful for them as we go through this. Okay, so let's start with the operator. One thing we like to look for is how long has the operator been in business? Years in business. And the reason being, if somebody got started 2 or 3 years ago, they look like a rock star. Everyone's looked like a rock star that's gone into real estate 2 or 3 years ago because the market has carried so many people forward. So our minimum, what we look for with our operations team that we partner with, is a minimum of 5 years. And we actually prefer more, but in our experience and in the partnerships that we've had, this is one metric to look at. If they've at least been in business for 5 years, they got in before this huge increase that we saw in market valuation, and they were able to adapt with not only the increase of appreciation, but then also going through what we've been experiencing the last 12 months with the market shifts and loans and things like that. So that's for us. We make sure that they've been at least in business for 5 years doing multifamily, not 5 years in storage, not 5 years in single family, not 5 years in industrial or retail, 5 years in multifamily. So that way they have a good foundation of how that business is ran. So that's the first thing we look for. The second one is how many deals have they taken full cycle. And the minimum that we look for, again, is 5 deals full cycle. And what does that mean? Full cycle is from the time they close on that deal until they exit that deal. And a typical business plan in value add apartment real estate is 3 to 5 years. That's pretty typical. So if they've been in business at minimum 5 years, and if they've taken 5 deals full cycle, we have a little bit more confidence in that operator because every deal is different. Even though the root of the business plan is going to be pretty similar, every deal is different. There's new challenges, there's new tenants, there's new repairs, renovations. There's so many different things that go into individual deals. So if they've taken 5 of these full cycle, then they've got a pretty good grasp. At that point, they're going to have a good renovations system, or should have a good renovation system in place, good relationships with management, with brokers, and everything that's required into going in to manage that asset effectively. So that's the second one. Years in business, how many deals they've taken full cycle. And again, I'm stressing this is minimum. The more you can get, obviously, the better, okay? So another question I like to ask, when did a deal go south? And maybe it didn't go south, but maybe it just didn't work out as planned. There are challenges in every single deal. And with operators, our goal is to reach a certain expectation or target returns. And things happen. Market changes, supply chain issues, things change. But I like asking those questions to see how open they are about their business. And if the deal did go south, what did they learn from it? What did they learn from it, and what have they implemented today to prevent something from like that happening again? I understand that things happen. I think a lot of people do. Most people are pretty understanding that not everything's going to be sunshine and rainbows, especially in real estate and investment. But I like asking this question because I want to see how open these operators are with us, especially with us, because at Rev, we connect capital to deals. We help people place that capital. And so we want to know how open they are. We want to know how transparent they are with how deals have been operated. So that's a third one. When has a deal gone south, and what did you learn from it? Or when did it not go as planned? Another one I like to ask is their track record. What is your track record? I want to share this with you. I'm going to share my screen real quick. Okay, is this coming through all right? Okay. This is one of our partners that we partnered on with our last 2 deals. We had an investor that wanted to see and asked about their track record. And so they had this ready to go. So don't be afraid to ask for your operator's track record. And keep in mind, when you get into these large apartment syndications and funds, it's not uncommon for people to team up together. And so there might be one partner that carries a lot of the experience, and that's okay, as long as they're the one overseeing the deal. So, and that brings up another good point. So knowing that people partner up, that would be another question I would ask is, hey, out of the GP group, the general partnership, how many deals have you guys worked on together? Or your current team, how long have you been together? Because if this is their first deal that they're all coming together on, it's not that it can't be managed or operated effectively, but if they haven't done a deal together, then could there be confusion? Could there be disagreement in the business plan 2-3 years down the road? So just another thing to consider. So I wanted to share this with you as a track record. So Dustin Miles He's the president over at Momentum Multifamily, really sharp guy, engineering background, super great people. And this is his partner, Hayden Harrington. So this is what they shared with one of our investors. And I just like how clean and simple it is to show. It's just a track record. So it shows the property, it shows the lender, and we'll come to lending and loans here in a minute, the units of the property, and then what the return is. So if it's current, then they currently own it, obviously. So you can easily go through and see, hey, 2.76, that's a pretty good return, break even. Okay, so if I was looking at this track record, I'd say, okay, well, I appreciate them saying that they didn't generate a return for their investors, but what happened? What happened on this one? And I believe, Jim, you might recall better than me. I believe this one was a property management issue that they didn't get in and take care of quick enough, being the asset managers. I believe that was the case, and it was the market. So they were in Edmond, Oklahoma, which is a smaller market, and things just didn't appreciate the way that they were expecting. So they learned from it, and they're not doing any deals in Oklahoma anymore. So going through, you can see, I mean, they've been doing pretty well. 1.95, 3x, 1.65, 2.25, 2.9, some current deals. And then at the bottom here, 13 total properties, 13 loans, total of over 2,000 units that they've been GPs on, with just over 200 million of assets that they've seen. This is a track record. This is what you should be provided with when asked, when you ask an operator for it. So just wanted to give you an example of that. Okay, track record. And one of the fifth question that I would ask, and I'm gonna star, highlight, underline this one right now, especially right now. Has there been a capital call performed? And what a capital call is when you get into these syndication deals and funds, in the paperwork, in the legal documents, the managers have the right to perform a capital call if that's what's required for the property. So if things end up being short $500,000 for renovations or something, they have the right to go to their investor network, the people that are in that deal, and say, hey, we're performing a capital call. We need X amount of dollars. And that's usually dependent on your percent of ownership in the deal. That's a capital call. And what's happening right now is capital calls. So a lot of investors may have put up 50,000 or 100,000, and now they're getting pinged again for another few $1,000s or more. It could be significant because some of these operators got into loans that are now coming due. And with the market and the interest rate shifting, they need to recapitalize, meaning they need to bring more money into the deal to increase the equity in the property so that they can qualify for these loans. I'm hoping that makes sense. So I like asking this question: have you ever performed a capital call? It happens. There's things that are unexpected, but if somebody hasn't, what's been preventing them from performing that capital call versus some of these other groups? And if somebody did perform a capital call, what could they have done differently to prevent that? Did they not raise enough money up front? Were they too aggressive on their underwriting? Did they not secure good enough loan terms for a conservative investment? These are the types of questions that you want to be asking. And simply by asking, have you ever performed a capital call, can tell you a lot. Now, Jim and I had the opportunity to meet with an operator last week, and we went through not just these questions, but a lot. I mean, we sat down for an hour and we were asking questions about their business, their operations, management, all this stuff, because this is a group that we're likely going to partner up with. Jim, do you mind sharing some of the comments and experience from that?
Sure. So, one, it was a great conversation, right? That hour flew by, and I wish we we would have had another hour to continue the conversation on. It was awesome. So really I guess some of the key highlights there, things that we focused on, communication, right? How does this operator communicate with their investors? How would we recognize that communication to pass on to our investor pool as well? Trying to think of some of the things that you haven't already touched on here, Dallin, because we went through all of these questions. I think some of the other, key focuses is financial stability. You talk about it in the capital calls there, but just as an organization, how are they managing their organization? Are they conservative? So we dig into that quite a bit. Are they able to, sustain through the swings of the market and the ups and downs? Do they have enough capital reserves in place? Is their overall business actually financially stable, right? So you got to ask those hard questions. You got to dig in. Now, when we were talking with this particular operator, they're super impressive. They've got great systems in place. They're building out their own systems, right? Their own software platforms. They're fully integrated, self-contained, which is awesome. But it's not the only way, right? The other pieces, I guess, from this particular operator that we talked about that really impressed me is just their vision on the market and where they're at. And they've been conservative ahead of the market, and meaning that, they, even when there was this huge hockey stick of upswing and appreciation, they still remained conservative. They still sat back and were like, we don't need to take 85% leverage on this loan. Let's not do that. And they've positioned themselves in a really good spot now to be able to, to manage the rough seas ahead. So
yeah, they that was a big one that stuck out to me, and I'm glad you brought that up. So when all these banks were doing 85% leverage, they were still only borrowing 70%. So they could have gotten more leverage from the bank, but they chose not to, and they brought in more equity because they knew if the market was to shift, they would have enough equity in that deal that they'd be able to refinance out of it. They've also never performed a capital call. And they listed off a few companies that we're well aware of that have been performing capital calls. And what's unfortunate is that some of these people are the ones that you might see all over social media that look like they're just absolutely crushing it because they're buying this multifamily, they're renovating this, they look like freaking rock stars. But to their investors are now having to ante up more money because they were a little too aggressive with their takedown. So these are questions you've got to ask. These are things you want to know ahead of time. Just because somebody looks good online, just because they have a track record, right? There's so much more that goes into it. And listen, we're just scratching the surface on some of these questions. These questions are not enough for you to determine if the operator is sufficient enough to invest with. These are just questions to give you an idea to feel comfortable if you should pursue the due diligence on them or pass on it. Like, this is very basic stuff. So there's a lot that goes into it. But the great thing is, this is where we come in. This stuff is good for you to know, but you don't have to know all of it. You just have to know us, Rev, and our team, because our whole goal is to make apartment investing easy. So with that being said, we still want everyone that we work with and partner with to be educated and have a certain minimum level of sophistication in this space. So capital calls was a big one. Another thing that really stuck out to me about this operator is their renovation plan. So they are turning and renovating 178 units per month. 178 units per month. And they're averaging, let's see here. He says they average about 16,000 per unit renovation. Just make sure I did that math right. That's $2.8 million, almost $3 million a month that they're spending on renovations. So a big part of value add real estate is having an effective management plan, having a system in place, especially for your renovations, because getting into deals that might have below market rents of $300-400, you got to go in there, renovate these units quickly, and then get them leased up at market rents. So they have a relationship now, and since they're doing so many of these, they're wholesaling all their materials from Asia. They're wholesaling everything, buying it in bulk. It ships to this warehouse. This warehouse packages everything onto a single pallet that specific unit needs. We're talking doorknobs, lights, cabinets, toilets, everything that unit needs. This warehouse packages it on a pallet, and then they deliver it to that unit. So then this team just goes in, everything they need for that specific unit is right there on the pallet. They cut off the saran wrap and they start piecing everything together. This is a system that they have in place to be able to maintain such a high level of productivity in apartment renovations. These are the things that aren't often talked a lot about that you should be asking about. How many units are you turning a month? What types of finishes are you doing? Are they doing lipstick? Are they just painting the cabinets, painting the countertops, and only spending $3,000 per unit? And I'm not saying that that's a bad thing, but just be aware of the business plan and what these people are doing. Any questions on operator related questions that anyone has?
Dylan, I'll throw one more that you should probably put on your list there is dig into their understanding of legal and regulatory compliance, right? The SEC is starting to crack down on people harder and harder. So you need an operator that you can trust is doing the right thing and that they're not going to run into a problem later on down the road.
This was a big one that Jim and I became made aware of recently. Very big operator. If you're at all involved in the apartment space, you know this person. I'm not going to share them by name, but they got caught up in with the SEC, and they had 30 or 40 other investors that got subpoenaed into this situation because they weren't 100% compliant with the SEC. This stuff happens, and it's not stuff that most operators are going to freely and readily disclose or share with you. But if you ask, they should. And I think most would, because most operators, I like to think, have investors' best interest at mind. But if you're not asking the right questions, they're not at liberty to really disclose. Like they might not liberally disclose that or share it with you. So I appreciate you bringing that up, Jim. Any other questions here? If not, we're going to move on to the market. Cool. And if
Hey,
you're
Dal,
taking, yeah,
I just wanted to just throw out a thought there. If you're looking to passively invest, like it's okay if you know somebody that's new to the space as an operator. But an important thing to ask is who are you working with? Who are your partners that have that experience?
yeah, that's a really good point. Because a lot of people bring in different values to teams. So when it comes to the operator, who has the asset management experience? Who has the renovation experience? Who has the loan experience, right? Cool. Okay, so let's touch on the market here. So the data and details that I'm going to share with you, these are not, it's not data that I established. It actually came from a gentleman by the name of Neil Bawa. A lot of people in the space are familiar with him. He's very analytical and data driven, and he has a whole team that's constantly looking into the market and metrics and phenomenal resources that he provides for free. So these are the metrics that we follow when we're vetting a market. So one of the things that we look for is income growth. And keep in mind that these numbers that I'm going to share with you, these percentages of increases, It's not over the last 1 or 2 years or 3 years. This is over the last 20 years, because what we're looking for are long-term trends. And that's what helps us decide and determine what markets that we want to invest in. Right. When it comes to operating a deal, and I'll get into it on the third point, we do have some aspect of control. How we renovate the units, how we manage it, like we can force appreciation that way. The market, we don't have any control of. So we like to stack our deck the best we can. So we look at these trends over 20 years to determine, hey, is this a healthy market? Is this a strong market that we feel comfortable investing capital into? So income growth, your metric here is 30%. And I'll do just as a little note up here, over 20 years. So a 30% increase in the median household income of 30%. That's what you want to see in that market. And keep in mind too, like these markets, we're looking at Phoenix, we're looking at San Antonio, DFW, Houston, like big MSAs. When you get into tertiary and secondary markets, there's going to be a lot less of this data. So just keep that in mind. But if it's a secondary or tertiary market just outside of a primary market like Phoenix or Tucson or DFW, then that might be something worth looking at, because when those areas are growing, it naturally pushes people to the exterior markets, secondary and tertiary. So just keep that in mind. So income growth, population growth. And this you want to be over 20% over the last 20 years. The third one you want to look at is your median home, house, and condo value, which is going to be over 40% over the last 20 years. We look at the crime index. Has this been decreasing over the last 15 years? And all this information is publicly available. There's I'll share something here with you shortly that has some links that you can go to find out some of this information. So the crime index, has it been decreasing over the last 15 years? And job growth. And job growth is a little bit more short term. We're looking to see if there's been a 2% increase over the last year. So the last 12 months. Because there's a lot of factors that change into that go into that. But look, these are the metrics we look at when identifying a market. If you have income increasing, if you have population, people flooding in, if home values are going up, if crime is going down, and there's been job growth increase, these are all indicators of a strong, healthy market. So this is why we like looking at these areas to determine if, hey, is this an opportunity in a market that we want to be in? Now, keep in mind, Phoenix blows these numbers out of the water. DFW blows these numbers out of the water. Houston blows these numbers out of the water. So very, very strong. With that being said, there are areas in Phoenix I would not invest in. Okay. So when you're looking at the entire MSA or the entire metro area of that market, as a whole, it might be experiencing these things, but you've got to know the submarkets in that market. You've got to know the different neighborhoods, the streets. You've got to have boots on the ground. If you're investing with an operator that doesn't have boots on the ground or is super familiar with that market, I would be a little hesitant. I'd be a little weary. Because when you have boots on the ground, you know things and you hear things that you just don't if you're out of state. One of the most recent deals we just closed on back in December, it was in Houston. The sellers were out of, I believe, California, And this was their only multifamily asset that their portfolio owned. They weren't multifamily investors. They were out of state. Their management was horrible, which was good for us. This property was being rented, occupied at 88%, which all the other comps in that area were 94 to 96% occupied. So there was no reason that this property should have been so low in occupancy, but because it was out of state investors, it had nothing to do with the market. This is just a point on back to the operators of are they involved? Are they visiting? If they are out of state, are they there every month? Are they there every other month visiting and really overseeing the management of that property? So this is another thing I want to share with you. Another tool and resource that we use at Rev. Again, I didn't put this together. I did clean it up a little bit, but this is the data and information and the spreadsheet that Neil Bawa provides freely for anyone. So this has the population growth, income, house value, crime, and job growth. These are some markets that we've looked at, and you put in the information back in 2000 up to 2021. If everything's toggled green, then it hits that minimum. And so when we're exploring or looking at a new market, we do this market analysis. And this is high level. This isn't like, hey, we did this. Yeah, let's absolutely go in. No, we do this and we say, okay, let's take it to the next step. Then we go visit that market. We walk the neighborhoods where the property is that we're looking at. So just another useful tool to have to be able to vet markets. Any questions about market? Cool. And Hillary did put in the chat box, there's a checklist. All this stuff that I'm sharing with you, I put together into a quick PDF that I want to give to you for being on our webinar. So it's called Investor Pass. Again, just because it checks all the boxes doesn't mean you should 100% invest in it, but take it to the next level and start looking in and doing that due diligence. Jim, was there anything you wanted to add to this?
Hello? Hey, Mundo. Oh, yeah, he's having trouble talking, right? Yes.
I think we need to mute
Yeah.
Sandra.
Got it. Okay.
No, I don't have anything else to add, Dallin. That was excellent. Good stuff.
Great. All right. So we've looked at the operator, we've looked at the market. Now let's look at the deal. And again, it's hard to know if a deal is a good deal or a bad deal because no operator is going to present to you something that looks bad. And I sometimes I shouldn't have to say that, but you do, because everyone gets so caught up in the deal and the numbers and the projected return, and they're prioritizing the wrong areas. Again, in my opinion, if you have a strong operator and you've vetted them, you've got a strong market and you've vetted them, the deal is really the least important. Now, that doesn't mean you shouldn't look at it and there shouldn't be certain metrics that you should be aware of. So that's what I want to share with you now. So these are, again, just a couple quick checkpoints that we like to look for when looking at a deal. And we've done a webinar with our underwriter, Will Hahn, a few weeks ago. We have that webinar uploaded to our YouTube channel. He goes into depth on underwriting deals and really what to look for. So very, very educational. If you haven't seen that one, log on to our YouTube and watch it. I promise you won't regret it. So the deal, one of the first things I like to look for is a 3 to 5% rent increase. So not super big, typically follows the trend of inflation. And the reason this is important is because in areas like Phoenix over the last 3 or 4 years, you're experiencing 10 to 20% rent increases year over year in Phoenix. That is not normal. So if you're looking at, like, even though the market was showing that and there was evidence over the last few years, again, these deals are 3 to 5 years long. So if you're looking at the underwriting that an operator presented to you and they're like, oh yeah, we're expecting a 15% rent increase year over year, red flag. Just because that's what's been happening over the last year or two, that is a very aggressive assumption moving forward. One of my favorite quotes about underwriting was from another fund manager, and he said, I got so good at underwriting deals that even I started believing the numbers. I got so good at underwriting deals that even I started believing the numbers. Keep that in mind. These are projections. There's so many things that can change, so many different variables, but what conservative approach are the operators taking with their current projections? And this is one of them. Are they at 3 to 5%? You might see people at like 1 to 3%. So you know that they're being really conservative. That's good. Those are things that you want to look for. The next one is the expense ratio. Now, caveat to this, you're going to experience different expense ratios with a lot of different asset classes and types of multifamily. For example, if it's a brand new build in Phoenix, your expense ratio, you might be right around 25%, 25-30%. So your expense ratio, your expenses are going to be very low compared to what that property is going to generate. Now, if you're getting into something that's older, maybe built into the 1980s, your expense ratio might be closer to 40 or 50%. So I just like to give a simple range here, 30 to 50% expense ratio. If someone's at 25, 20%, too aggressive. And if they have a reasoning for it, find out why that is. Now, in places like Texas, you're going to have higher insurance and you're going to have higher property taxes. So you might be leaning closer towards this 50%, where a similar asset, same year, build, everything in Phoenix, you might be looking at closer to 40%. So the market affects this as well. So you can, to find out expense ratio, call up some property managers in that area and just ask. Find properties that are similar to the one that you're looking to invest in and ask them. Say, hey, out of curiosity, what's your typical expense? I'm looking at investing in a deal. What's your typical expense ratio at your property right now? And they should be able to share that with you pretty quickly. So 30 to 50% expense ratio. This third point I want to touch on is the reversion cap rate. What you need to understand with cap rates is that they have an inverse correlation with the value of the property. If cap rates go down, values go up. If cap rates go up, values come down. And this is kind of what we've been experiencing over the last 6 to 12 months. So what the reversion cap rate is, that's worked into the model where operators will say, hey, we bought it at, we'll say, a 5% cap rate, but we're expecting to sell it at a different percent of a cap rate. If you ever see somebody, so let's say it's a 5% cap rate on purchase, if you ever see somebody doing their reversion cap rate that is less than what they purchased it at, so maybe they're saying 4.5%, do not get into that deal, period. Do not get into it, because this cap rate, you might look at this number and say, hey, it's only 50 basis points. It's only 0.5%. This is, with multifamily real estate, a lot of the gains come on the back end when you sell that property. So if they're saying, hey, we're going to sell it for significantly more based on the market, and they're basing their returns on that, They're putting too much trust in the market. The market's unpredictable and we have no control of that. So this is what the reversion cap rate is. And most operators, good operators, experienced operators will do a reversion cap rate, meaning that, hey, we bought it at 5%. We might sell it. We're projecting to sell it at 6%. And again, remember, as cap rates go up, values go down. So they're actually saying that, hey, we're going to sell it for 6%. So a good reversion cap rate to look at is 10 to 15 basis points per year that property is held. So if we use 10 basis points, say it's we bought it at 5%, they plan on holding it for 5 years. They're factoring 10 basis points per year. They're saying, hey, we're going to sell at 5.5%. That's what a reversion cap rate is. You want to, when you're looking at the underwriting of a deal, you want to make sure that cap rate is higher on the exit, because that shows you that this team is being conservative. Now, here's the deal. If the numbers work with this reversion cap rate, let's say the market is in favor and it actually sells at 4.5%, or it trades at 4.5% cap. That's all extra. That's a cherry on top of the deal. And that's what was happening these last few years in real estate. People were projecting to get 16% a year on their return, and they were getting 40% a year on their return because the market was in their favor. But going into deals, especially now, make sure this reversion cap rate is conservative. Industry norm is 10 to 15 basis points, but get an idea of where your operators are at. Okay, these are some big ones, especially now. What type of loan is being used? We're heading into a recession. We're already in a recession. What type of financing is being used to purchase these deals? Is it a floating rate? Is it a fixed rate? Is it a 10-year term? Is it a 3-year term? There are so many different loans that people can use to get into these deals. And what's happening right now, people got into deals 2 years ago. They purchased a rate lock, so their interest rate, when it increased for 2 years, that's now expiring. So now they got to come out of pocket. They're doing a capital call to recapitalize their projects so that they can refi out of these loans they got into 2 years ago. You've got to ask what type of loan is being used. There's short-term bridge loans, which are often interest only. That's not a bad thing, but how long is that rate lock capped for? For example, one of the deals we got into for a minimum of 3 years, that rate's not going over 4.6%. And then we have the option to extend it for another 2 years if we need to. So at minimum, we're at 5 years. So these are questions that you want to ask about the deal, because again, we don't know what's going to happen in the market. What type of financing do they have in place? The last one I would look at, and a lot of this stuff you could do with simple Google searches, apartments.com, call up some few people in the market there. This last one I would look at is the renovated rents. Let's say these rents are at $1,000 a month, and this team is saying, hey, after renovations, we're going to get these up to $1,600 per month. Is the market supporting that? Or are they trying to become the market leader in rents? Because if they come in and say, hey, it's $1,000, we're going to get it up to $1,600, and you do some quick searches and you realize, hey, everything in that area is $1,450, that would raise some red flags to me. So you want to make sure that their projected renovated rents are not too aggressive. Are they in line with the market? And are they increasing around 3 to 5% a year? If they're coming in high with their renovated rents and have a rent increase of 10 to 15% a year, they are being way too aggressive on their underwriting. We're all in investing to preserve wealth and to build wealth, not to lose our wealth. So these are metrics, things that you want to look at, deal specific, to make sure that you're getting into the right investment. And keep in mind, this is where most people start. They start looking at the deal. And that's a little backwards. This should be the last thing you're looking at. Because if you've vetted the operator, if you've vetted the market, and then you can go in, look at the deal and see, hey, okay, they are conservative with their underwriting. That is the process you want to look at. The OMD, the operator, the market, and then the deal. So again, what I shared with you today was probably about 5% of what you actually got to do on your due diligence. It is a lot of work, but at least this is a good starting point for you. And if it's something you don't want to get involved in, that's why Rev is here. That's why we're here, because we make apartment investing easy. So with that being said, that investor pass link in the chat box, that's a free resource for you guys to use to be able to look at deals. If you're not in our investor portal yet, I invite you to join. It's absolutely free. It's no commitment to invest, but by joining, you'll see some of the previous deals that we've worked on, and you will be one of the first to be notified of any upcoming deals. We're regulated by the SEC, so we can't partner up with investors unless we have that pre-existing relationship. We want to get on a phone call with you. We want to see what it is that you're looking for an investments and see if there's any synergy there between us and you. So Hillary just put that link into the chat box. I invite you to sign up. It takes 30 seconds. Again, absolutely free, but at least gets you in and more involved with what we're doing so you don't miss out on any other opportunities. So, Paul, Jim, do you have any additional comments that you wanted to make about looking at a deal?
I think you've covered it pretty well. As Dallin stated, I just want to reiterate, right? This is high level, guys. This is a non all-inclusive a list of things that we've got to look at when we go in to evaluate a deal. We talked about the operator, we talked about the market, we talked about the deal. So everything you've learned in this last, 51 minutes, 10x that on what you really need to dig in to, right? It's really got to go deep. And if you want to protect your wealth, right? And the hard income or the income you worked hard for, you don't want to lose it by going, oh yeah, that sounds okay. Let me go with my gut here, right? These are not gut moments. These are fact-based, data-driven decisions you got to make.
Appreciate you sharing that. We've been at this for 5 years, keeping a good pulse on the market, different operators, what's changing, what's adjusting. It's a lot of work, but we're passionate about it. We enjoy it. And that's why we do these webinars, because we want you to have a baseline knowledge. We want you to have a baseline understanding to know what to look for so that you can make wise decisions. Look, whether it's with us or with another operator, that's irrelevant. That doesn't matter. We're going to be doing deals whether or not you decide to partner with us, but I want you to at least have that minimum baseline of knowledge so that you're equipped to ask the right questions. Because I love multifamily. I love apartments. We're dabbling in self-storage as well, right? I love real estate. And my personal belief is that everyone should have some aspect, some investments in multifamily real estate. It doesn't need to be your whole portfolio, but I personally believe everybody needs to be involved in some aspect in multifamily investing. That's how strong I feel about it. So again, the link is in the chat box to sign up for our portal just to get plugged in. We'd love to jump on a call with you and just see where you're at. See where you're at, see what you're looking for. We may not be a good fit for you. And if that's the case, we'll recommend you to somebody else. We've been building our network for 5 years. So if we're not a good fit for you, that's okay. We can at least point you in the right direction. So encourage you to sign up. With that being said, and does anyone have any questions about the deal? Maybe underwriting, market, or operators that may have come up over the last few minutes? Man, I guess I'm just too good at presenting. I'm answering everyone's questions. Listen, folks, appreciate you all for tuning in again this week. Next week, we're going to jump right into other aspects of multifamily investing. So really appreciate you being here. Some of you, I've seen you reoccurring and coming back multiple times. So thank you. That lets us know that we're delivering valuable content. We want your feedback too. So if there's suggestions, if there's things you would like us to do during these webinars, let us know. Let us know, because this is really for you. So appreciate you all tuning in, and we will see you next week.